Raymond James downgraded shares of Amazon from strong buy to outperform, citing risks related to tariff headwinds and massive AI investments. The firm also cut its price target on the stock by nearly 30%. Joining us now, the analyst behind that call, Josh Beck, Raymond James Managing Director of Equity Research. Josh, thanks for being here. So we're getting earnings from Amazon shortly here. And so there's a lot of scrutiny on tariffs and what the impact is going to be. So what are you focused on in terms of, I guess let's take the retail side of the business first and sort of the sell-through from items that get shipped from China. What's the direct impact there?
Yeah, well, thanks for having me on. So I think everybody is going through this exercise with the Mag 7 and really a lot of tech stocks. What do China tariffs mean to the business? Amazon is certainly an interesting story. In the retail business, there's a couple of different exposures that they have. The first party business is really where they're selling either their own products, Amazon Basics, or wholesale agreements with other brands like Nike, for example. A lot of those goods end up being China sourced. So there's certainly a concern, and one of the main reason that we cut our numbers is you could see inflation on the COGS, and obviously that pressures gross margins and can pressure operating margins. So I think that's certainly of really high interest to investors. The other one, I spoke with a lot of investors yesterday, is really the third-party business. So this is where a smaller seller is effectively using Amazon as a distribution platform. And in this case, the way that it flows through the P&L is really a certain amount of take rate on the amount of sales of that third-party seller. So there's been a lot of questions that I've been gathering on what could Amazon do maybe to help provide relief to these smaller sellers. Could they offer them a concession on fees? How could they kind of help them remain whole? Because it is really important for Amazon broadly to have high utilization of their massive utilization of their logistics and shipping network. So those are really, I think, front and center. Advertising as well. Many first-party and third-party sellers advertise on the platform. So within the retail business, those are really the main exposures to keep an eye on.
So when you add all of that up, what's your best guess for the potential hit here that we could hear about from Amazon?
Yeah, so we ended up taking down our out year. So just to be clear on the timing, so a lot of this is really a second half issue. So obviously the tariffs started to work their way through in April. You have certainly a freight time from China. You have inventory that you can pre-buy. Probably start to run through that towards the end of Q2. So this is really much more of a second half issue. So what we did is we cut our second half numbers and we cut our 2026 numbers. Our EBIT, which is really what a lot of investors focus on because they do guide to this metric, at least one quarter at a time, by about 12 billion, 12, 13 billion. And as a result, we're about 12% below the street for 2026. So I think a lot of investors feel like the multiple is quite undemanding at this level. It certainly has come down a lot this year, but the biggest question to them is, when have the numbers been de-risked? I still feel like the street numbers are too high, so we're waiting for that to happen. I think the main thing investors want to hear on this call is, what is Amazon doing to diversify their supply chain, and how quickly can they do it and at what cost? So that will really be, I think, the most important item on the call.
Right, and for people who are watching, they're reporting on May 1st is when that report is due out. So you are not a bear on this stock, to be clear. And so I wanted to get for you to just explain a little bit more to viewers. When you're going to an outperform from a strong buy, what does that mean effectively if I'm an investor or a potential investor and I'm trying to figure out what to do with the stock?
Yeah, so at Raymond James, we have a four-tiered rating system. A lot of times it's a three-tiered system. So strong buys are reserved for companies where you see greater than 15% upside, and you more or less see things playing out in that direction, pretty clearly. In this example, we feel like the multiple is de-risked, but we do still see risk to numbers themselves. So what we'd like to see is a message from the company that, right, they are investing. There is probably some further investment cycle that the street needs to think about, and see numbers de-risked. And then I certainly think it's an interesting long-term story for investors. They have great drivers in terms of what they're doing with AI in their cloud computing business. This is a multi-billion-dollar business growing triple digits. It could easily be a $5 to $10 billion business. So there certainly is a really interesting, I think probably undervalued at the moment, asset in AWS, but we'd like to see things de-risked. If we felt like the numbers were more reasonable, I think you could see us maybe revisit the framework. But at the moment, we see a little bit of risk to the numbers next year. So we're kind of looking for that to get right-sized.
Gotcha.